Hi, I'm Linda Eedes. This is an update on the RECM Equity Fund, which is of course our local equity portfolio benchmarked against the JSE All Share Index, talking specifically to the third quarter of this year, 2018, and then looking at the returns of the quarter, the sources of those returns, and concluding with how the portfolio is positioned within the sort of context of the local environment. So looking at the third quarter of the year, the fund was down 1.1%. Which isn't great, but it is better than the local equity environment, which was down 2.2% if one looks at the returns of the All Share Index overall. Year to date, the fund has actually performed a lot better than the market. The market is actually down more than 10% over the year to date. The fund is down 3%, but if you actually take a step back and look at how this fund has performed over the sort of last 3 years, has actually outperformed the All Share by almost 2% per year net of fees. In fact, since the start of 2016, which was really when the cycle turned sort of in favor of value-oriented portfolios, this portfolio is up 42% after fees relative to the South African equity market, which is up just under 10.5% for that full period of time. So I think if you look at what has sort of come under a lot of pressure over the year to date, many of the stocks which are down are the large caps, which have very much dominated headlines, were at one point very much the market darlings, and which a benchmark-oriented portfolio would have a lot more exposure to. So, of course, I'm talking about most notably their Naspers, which is down as we stand towards the end of October more than 20% year to date. Other businesses which at one point were very much lauded by the market, such as Aspen, which is down 40% year to date. Tiger Brands is down 46%. Woolworths is down 26%. So a lot of the businesses which had been doing incredibly well, where the sort of market got carried away with those good times, extrapolated them into the future, put these businesses on very high valuations at the time, and where things didn't turn out as well as the market expected, or where things just happened which weren't expected, such as, for instance, the listeriosis issues with Tiger Brands, that really sort of can have a significant impact on portfolios where you have excessive valuations and things don't work out and prices fall dramatically from that point. Being a value-oriented portfolio, we don't start with the market index, we start with a blank piece of paper, and as a result, we don't have exposure to many of those names, haven't had exposure for quite some time because they have been on very high valuations. In fact, all of those names that I've just mentioned, we believe still are on high valuations despite having fallen so much. They're not quite in value territory yet, although obviously we'll be keeping a keen eye on them along with many other businesses which have come under pressure. And we do have a bit of cash in the portfolio to actually put to good use when those opportunities arise. At the moment, the cash is about 12% of the portfolio. But if you look at the quarter and sort of what contributed and what detracted, some of the things that contributed to returns were our exposure to FirstRand. Actually, despite the sort of negative economic climate, usually banks don't do very well with that backdrop, but FirstRand actually came out with a set of results which sort of were more resilient than the market was expecting. So the share price actually went up during the quarter. And then Bowler Metcalf, which we have exposure to, packaging company, actually finalized the sale of its beverages business, Softbev, and declared or announced a special dividend with part of those proceeds. So the market liked that. Those were sort of two that jump out as being quite strongly positive. On the negative side, though, we did have exposure to MTN, which you probably will be aware of. In terms of the headlines, the Nigerian authorities claim that they have sort of taken money out of Nigeria legally, which they need to sort of pay back, and that they owe $2 billion in back taxes. Obviously, this is all under dispute. MTN claims that this is not the case. But I think the important point to note with MTN is that despite the fact that it was one of the biggest exposures in the portfolio, the returns, the negative returns, did not derail the entire portfolio returns. And I think that's really important because this is a very important lesson that we learned the hard way in 2014, 2015, when we had too much concentration risk, to resources, very narrowly sort of and very highly correlated exposure to platinum in particular. So we consciously now seek to diversify the portfolio as much as we possibly can, with a tilt towards quality businesses. So we do allow some non-quality businesses into the portfolio if they are inordinately cheap. One of the strong contributors during the year to date has been a business like Stefanuti Stocks, which is by no means a quality business, but has been through an incredibly tough time, and where sort of the valuations are incredibly low. And we do make sure that the majority of the portfolio, even on the local context, is dominated by businesses which we consider to be quality businesses with the right characteristics. So that does mean that there is a robustness about the portfolio which we believe will stand the portfolio in good stead through sort of difficult economic circumstances. But overall, I think this portfolio is a source of good returns for investors going forward. It's able to access a lot of the mid and small cap opportunities in the industrial side in particular, where there is emerging value. And I think that this is important because although there are a lot of smaller asset managers in the South African environment, many of them have emerged because they are more growth or momentum oriented. In other words, they've done very well. Their returns have been very good sort of over the last 5-7 years. But that does mean that their DNA and the way they think about investments is not suited to accessing those small and mid-cap value opportunities. So it's not only your ability to invest in those investing opportunities, but also your willingness. You know, are those the kind of businesses that you would buy? The businesses which have been going through quite difficult circumstances where you have to kind of look through that short-term sentiment. And I think that this is a portfolio which is going to prop up a lot of more diversified portfolios with other funds in it, because this is the portfolio which is really going to be generating returns in the absence of returns from sort of the overall market environment.